The truth about today's stock market valuations isn't as simple as overvalued or undervalued. It's layered, it's nuanced, and more importantly, it's shaped by forces that didn't exist in the same way a decade ago. If you've been looking at the market lately and wondering whether we're in a bubble or on the edge of something bigger, you're not alone. But to really understand what's happening, we need to step back and look at the bigger picture. Right now, stock market valuations, especially in major indices, are sitting at historically elevated levels. Metrics like price-to-earnings ratios are above long-term averages, and that naturally makes investors nervous. Traditionally, when valuations get stretched, it signals that future returns may be lower or that a correction could be coming. But here's where things get interesting. The context behind those numbers has changed. One of the biggest drivers of today's valuations is the dominance of a handful of mega-cap companies. These are businesses with massive profits, global reach, and in many cases, near monopoly-like advantages in their industries. Unlike past market leaders, these companies are not just growing, they're generating enormous cash flows while doing it. That changes how investors value them. Higher valuations might actually be justified when companies are this profitable and this dominant. Another key factor is interest rates. For years, ultra-low interest rates made stocks more attractive compared to bonds or savings. When money is cheap, investors are willing to pay more for future earnings. Even though rates have risen recently, we're still in a world where long-term expectations matter more than ever. If investors believe that earnings will continue to grow strongly, they're willing to accept higher valuations today. But this leads us to a critical question. Are those expectations realistic? Because at the heart of every high valuation is a belief about the future. And right now, much of that belief is tied to technological transformation, especially artificial intelligence, automation, and digital infrastructure. Investors are pricing in a future where productivity surges, costs drop, and entirely new industries emerge. If that future plays out, today's valuations may not look so extreme in hindsight. However, there's always another side to the story. High expectations create a fragile environment. When markets are priced for perfection, even small disappointments can trigger sharp reactions. A slowdown in earnings growth, unexpected regulation, geopolitical tensions, or shifts in consumer behavior, any of these can quickly change sentiment. And when sentiment changes, valuations can compress fast. This is why some analysts argue that the market isn't necessarily in a bubble, but it is expensive. And expensive doesn't mean it has to crash tomorrow. Markets can stay expensive for years if the underlying fundamentals support it, but it does mean that risks are higher and the margin for error is smaller. Another overlooked aspect is the role of passive investing. Over the past decade, more money has flowed into index funds and ETFs than ever before. This creates a kind of self-reinforcing cycle. The biggest companies get more investment simply because they're bigger, which pushes their valuations even higher. So what comes next? There are a few possible paths forward, and none of them are guaranteed. One scenario is that earnings catch up to valuations. In this case, companies continue to grow strongly, and over time, valuations normalize without a major market drop.